Did you buy or sell crypto this year? Or maybe use it to purchase something, even as small as a sandwich? If so, that transaction might need to be counted on your taxes.
It's especially important to talk about taxes during this 2022 tax filing season because so many people bought or sold crypto during 2021 for the first time.
The number of crypto owners worldwide nearly tripled in 2021, growing from 106 million in January to 295 million in December, according to a report by Crypto.com. For those crypto newcomers, Wall Street Journal tax columnist Laura Saunders has a warning.
I think that the IRS has a special focus on crypto because they're uncomfortable with it. They see it as a kind of a threat to the tax system. They think it may attract criminal activity, money laundering, or tax evasion. So the IRS is paying very special close attention to cryptocurrency.
Here are 5 things you need to know about taxes for cryptocurrencies. First, how to report. You'll see this question on the Form 1040 right below your name. Be sure you answer it accurately.
If you don't answer the question or if you lie and they later have a case against you involving crypto, it will probably be a lot easier for the IRS to win that case.
But once you check the box, how do you know how much you owe? To find out, let's look at how the IRS defines the currency.
Since 2014, the Internal Revenue Service has classified cryptocurrencies as property, usually investment property. That means they're not like dollars or euros. They're much more like shares of stock, like Apple or IBM shares.
And like income on stocks and bonds, the law has different rules for short and long-term gains on crypto.
If you've held it for a year or less, it's a short-term capital gain or loss. If you've held it for longer than a year, it's a long-term capital gain or loss. And those gains, if they're long-term gains, can be taxed at much lower rates than, say, wages. So the top rate on wages might be about 40%. The top rate on long-term capital gain on cryptocurrency would be 20%. That's a big difference.
The good news is that capital losses can be used to offset the gains, meaning you can pay less in taxes for the money you gained in crypto if you also lost money investing in the currency. But capital gains on an investment isn't the only way people use crypto. Some are using the currency to buy goods like that sandwich or even a yacht.
If you're holding your crypto in a taxable account versus, say, a retirement account like an IRA, and you use it to purchase something, then you have a taxable transaction.
This isn't a new idea.
That's just as though you were buying that item with shares of stock, say shares of Apple stock. And just the way that if you transferred the stock to someone, you'd have to tell the IRS and have a loss or gain, the same thing is true with crypto.
Also similar to stocks, the IRS is trading between 2 different entities, such as from Apple stock to Microsoft, or in crypto's case, from Bitcoin to Ethereum, are taxable transfers. What we just discussed applies to buying and selling cryptocurrency and other tangible goods. Where it gets trickier is if someone is paid for services in crypto, which happened on a big stage in 2021. The mayors of both New York City and Miami tweeted their plans to accept at least one paycheck in Bitcoin, plus more businesses are offering pay in crypto to attract younger workers.
In that case, it's compensation. So you owe income tax on it, but you also owe payroll taxes, such as Medicare taxes and Social Security taxes. After you pay those taxes, it becomes an investment.
But if the crypto is a gift rather than a payment for a service,
neither the giver nor the recipient owes any income tax on that transfer. But when the recipient ultimately sells the crypto, they have to use the giver's cost basis to figure the capital gain or loss. It's not the value at the time the gift was received, it was the value when the giver bought it.
And if that value goes up, the recipient would have to pay taxes on the gain when they go to trade or sell. So keeping a clear record is key. Many people have what they call hot and cold wallets for security purposes, but this also helps organize records.
The cold wallet would be kind of like your savings account. You don't touch it. The hot wallet would be the one you're trading from. And so you could tell the IRS, no, you don't have to worry about the cold wallet. Let's look at the hot wallet. This is the one I was working with.
Transferring crypto between these 2 wallets is a non-taxable transaction. The IRS's rules on cryptocurrency are evolving as crypto itself evolves and moves into the mainstream. Some digital assets like NFTs don't have official guidance yet, but many tax specialists think they should be taxed like collectibles such as art or antiques. In that case, the top tax rate is 28%, which is higher than the top rate on cryptocurrency trades.
My advice would be, even if there aren't rules, don't think you can do whatever you want to do. If you don't report correctly, the IRS may find out about it. For instance, they've talked to judges and been successful in getting customer records from places like Coinbase that they can use to match against people's tax returns and generate cases.
The tax deadline for 2022 is April 18th. For further tax questions, see the Wall Street Journal's 2022 Tax Guide.